Hello, and welcome to Sessions on Financial Market Regulatory Practices, or FMRP, which focuses on the financial markets in Singapore. In this section, we will explore the essential aspects of the financial market regulatory framework in Singapore. As you may know, financial markets play a critical role in the economy. They facilitate the movement of funds, create liquidity, and enable various financial products and services to meet the needs of individuals, corporations, and governments. However, without proper regulation, these markets could become chaotic and prone to misconduct, inefficiency, and instability. So, why are financial regulations important? And what is FMRP? What is FMRP? FMRP refers to the set of rules, guidelines, and best practices that govern how financial markets operate in Singapore. These regulations aim to ensure that the market functions efficiently, transparently, and fairly. In Singapore, FMRP is crucial for maintaining the integrity of its financial system, which is one of the largest and most active in the world. The primary goal of FMRP is to ensure that the market remains free from manipulation and malpractice, while also safeguarding investors and fostering a healthy economic environment. It helps market participants, whether banks, asset managers, or brokers, operate within a framework that promotes fairness, transparency, and accountability. The role of financial regulations in Singapore. Singapore is known for its robust regulatory framework, managed by the Monetary Authority of Singapore, MAS, which is responsible for regulating various sectors of the financial industry. The MAS works to ensure that Singapore's financial markets remain globally competitive, while also protecting the interests of market participants and the broader economy. Market participants in Singapore, whether they are banks, insurance companies, or trading firms, must comply with these regulations to maintain confidence in the financial system. The adherence to these regulations is vital to the stability of the financial market, ensuring that everyone from small investors to large institutions can participate safely and fairly. In this course, we'll delve deeper into the specifics of FMRP as it applies to various financial markets in Singapore's financial sector. By the end of this module, you'll have a clearer understanding of the essential regulatory practices and why they matter to you as a financial market participant. In this section, we'll discuss various market participants in Singapore's financial ecosystem. Understanding the roles and distinctions between these participants is essential for grasping how the financial markets operate and how regulations apply to different types of entities. Singapore's financial markets are composed of a diverse range of players, each contributing in a unique way to the market's functionality. These participants are typically divided into two broad categories: sell-side participants and buy-side participants. Sell-side participants. Let's start with sell-side participants. These entities are generally responsible for creating, selling, and distributing financial products. They act as intermediaries between the financial markets and their clients. The key players in the sell-side include 1. Banks and merchant banks. Commercial banks and merchant banks are fundamental players on the sell side. They offer a variety of services, including market making, trading, and investment banking. They help in underwriting securities, facilitating market transactions, and providing liquidity to the market. 2. Broking firms. Broking firms, including both traditional and electronic broking services, play an essential role in facilitating the buying and selling of financial instruments. These firms act as intermediaries that connect buyers and sellers of securities. 3. Interdealer brokers, IDBs. IDBs serve as intermediaries between financial institutions. They specialize in wholesale markets and facilitate trades between institutions, particularly in markets such as foreign exchange and money markets. They provide price discovery and help ensure liquidity in markets that are less transparent. 4. E-broking services. With technological advancements, electronic broking services have become a dominant feature in financial markets. These platforms provide automated services that enable faster and more efficient transactions between buyers and sellers. Now, let's look at buy-side participants. These entities are typically investors who purchase financial products, such as securities, derivatives, or other investment instruments. They are generally looking to invest capital with the aim of achieving returns. The main buy-side participants include 1. Asset managers. Asset managers manage investment portfolios on behalf of individuals, corporations, and institutions. They make decisions about where to allocate capital in various asset classes, such as equities, bonds, and derivatives, with the goal of maximizing returns for their clients. 2. Sovereign wealth funds. Sovereign wealth funds are government-owned investment funds. These funds are typically used to invest in various asset classes to generate returns for the nation's economy. In Singapore, the Government Investment Corporation, GIC, is a prominent example of a sovereign wealth fund. 3. Pension funds. Pension funds are investment pools used to manage retirement savings. They invest in long-term assets to ensure the growth of funds for future pension payouts. Pension funds are large institutional investors and often have a significant impact on the financial markets. 4. Insurance companies. Insurance companies also fall into the buy-side category, as they invest the premiums they collect in order to generate returns. These investments are typically focused on long-term stability and growth, including equities, bonds, and real estate. 5. Hedge funds. Hedge funds are another example of buy-side participants. These funds employ a variety of investment strategies, including using leverage, short selling, and derivatives, with the goal of achieving high returns for their investors. 6. Corporate treasury departments. Corporate treasuries are responsible for managing a company's liquidity, investments, and financial risk. They often invest in money market instruments, bonds, and other short-term securities to meet their operational needs.